Well, hi folks, we're here and we're back. Great to see a number of people on the chat, and Damien's queued up ready to come in just a second ago. So I'm now broadcasting from Bath in the UK, and so it's just around 11 a.m. in the morning. And some or two people asked about, am I broadcasting from the Roman Baths? Not today, but I am broadcasting on my portable system. So in theory, I could stream from almost anywhere. I should also explain, by the way, that the system is by no means as flexible as my normal system, which is still in a crate somewhere between Australia and here. But nevertheless, we can get a basic show going. And just before I bring Damien in, as normal, let me just remind you that we don't provide financial advice. This is a general conversation only. The chat is moderated, so please watch what you say, but feel free to contribute in the chat. And we also have Super Chat enabled if you'd like to make a contribution to what we do here. Greatly appreciated. And if you'd like to ask a question, again, put it in the chat and make sure you use @RuleTheWorld. That'll make sure that I see it. Anyway, without further ado, let me see whether Damien is with me. Damien, are you there? Have you muted?
Great. Sorry, yeah. I had muted myself, Martin, just to scare you.
I nearly had kittens in. I thought it's all working at my end. What's gone on? Well, great to have you back on the channel, Damien. And I think we missed a month or so with all the moves and everything, but quite a lot's been happening. It's a lot to explore. We had the RBA rate rise, of course, which many people were unexpectedly caught out by, but I was suggesting it was quite likely. We've had First Republic Bank roll over and picked up by JP Morgan. We've got the tech sector, well, going boom, but maybe not quite when you start to look. And a bunch of other stuff to talk about too, property prices maybe as well. So where do we start?
Credit crunches, bankruptcies. We've got AI. Yes, there's a lot to go through. So I'll let you lead off with where you think sits, because I think a lot of stuff right around the world.
Well, let's just start with the RBA. So the RBA came out and lifted 25 basis points. And interestingly, over the last month or so, pretty much everybody had been saying, oh, no, the RBA is done. They're not going to lift anymore. And then, blow me, they went 25. And in their message, they basically said, we might have to do more. And of course, it's because the inflation numbers still looking pretty sticky. It's embedded. House
prices have started rising.
Yeah. Electricity prices, I think, are the real critical issue here. Food prices as well. And interesting, in the UK here, food prices were up 15.9% over the last year, which is amazingly high. And they're still up, going higher. So, wherever you look, same in the US, same in the UK, inflation is sticky and it's embedded.
Yeah, that's right. And interestingly, like a lot of these ones, is the inflation now is very clearly in the corporate sector, as opposed to like some of the base costs. So some of the base food prices have fallen, but you're still seeing the derivatives of them still rising. And so If you look at things like the UN food price index and things like that, that peaked a while ago, and the expectations that'll eventually flow through to the food prices you're paying on the shelf has been has been somewhat hasn't happened. And the question, how much of this is corporates, and quite a lot seems to be the answer. Almost all of it, if in some cases. And so the question then is, what do you need to actually stop corporates from keeping on jacking up prices? And well, I guess the answer is you need people to stop buying. And is that going to need a recession to get there? And I suppose yes. Looks like it's the answer. I think many people, and look, myself included, would have said, okay, once the core input costs to food have started falling, and all our transportation costs are all falling, then the output would then start falling, and that's obviously hasn't happened.
No, and interestingly, a lot of the discussion, particularly among the analysts, has missed this point about the cascading effect of supply chains and corporates basically charging the next body along, the next body along, the next body along. So at the end of the supply chain, which are, well, some businesses, but a lot of consumers, it's the aggregated build-up of inflation. And that's really sticky.
Yeah, it has been. I think I'm still relatively. I still think a reasonable recession will clear it very, very quickly. And I guess, and I'm also, and that's part of what I'm looking to buy, at the moment is really, and not buy is companies where I think they can hold on to their price rises, versus ones that just don't have the pricing power. And so, it's this real idea about quality companies, and the idea that, a great example right now is of not quality, of what I call value, traditionally value companies, are car manufacturers. Now, they were all forced by supply chain issues to produce fewer cars than what they wanted, and lo and behold, demand picked up, especially as nobody wanted to travel on public transport as much, and more people living further away, and things like that. And so what we saw then is this real jump in car prices. Now, when you listen to the conference calls from all the car manufacturers and talk to them, they're all saying, "Oh no, it's different this time. We're going to be disciplined. We're not going to try and flood the market with cars just to pick up market share and force prices back down. This is great. It's how great is it that we've got pricing power. We're going to keep the supply of cars low." And I'm like, there are a lot of car manufacturers out there, and they're not oligopolistic. So if you've got, say, Coles and Woolies making up most of the Australian market, and they're both sort of not overtly but tacitly just saying, well, let's just keep jacking prices while we can, then I can see where they can hold on to those prices, and that there's no real impetus to push down. When you've got a dozen or more major car manufacturers all around the world, and a Chinese guy who's going to say, or a Korean model that's going to go, right, Toyota, you don't want to produce enough cars? No problems. We'll fill that gap. We're more than happy to. And you want to try and jack your price from 20,000 to 30,000, even though your costs are still, costing you 15 to build. Well, we'll sell it for, you can sell yours for 30. We'll sell it for 20. Well, we'll sell it for less, to try and pick up extra market share and become the biggest car maker. And so, I look at those types of industries and say, well, when they can, they will. And if a recession hits and all of a sudden demand's starting to disappear from everywhere, then is Toyota going to say, well, we're going to run our factories at half mast because we want to keep trying to sell our cars, our $20,000 car for $30,000, or are they going to quickly bring the prices back down and try and get volume? And I think they'll chase volume in that type of industry. I think in somewhere else, say you've got a Microsoft who's jacked the price of Office 365. Are they going to turn around and discount that in the hope that lots more people will go out and buy more Office software? I'd say no. I think they're more likely to hold on to the margins and just sort of and keep the price rises coming through. And I think those, yeah, it's the companies with the pricing power, I think, are the ones to be holding at this point in the cycle, given all these events. And that traditionally, when you get a recession, this inflation disappears. And even recessions we saw in the 70s, that absolutely happened. That you had inflation, you got a recession, the inflation disappeared, you came out the other side, and it reappeared. And so that's where
and I think one of my observations is that this is actually creating an environment where the bigger firms can get bigger, smaller firms get crushed. I mean, look at the banking sector in the US, right? JP Morgan has expanded its footprint even more by now taking First Republic. So there is a very, very nasty side effect here, which is you're actually creating a greater concentration of a relatively small number of large players who then have more market pricing power to be able to take their margins even further.
That's right. And to be able to make political donations and and enjoy the fruit of their labors. I mean, I think there is a genuine case to be made in plenty of countries around the world that once incumbents can start donating too much to political parties to keep themselves, the rules and regulations around. It seems as if we went through this period in the Thatcherism and Reaganomics and things like that back in the 80s, where there was this real push for getting governments away and letting corporates decide and breaking up, companies that were too big and really trying to force competition. And I sort of think about today's scenario as being a bit of a real bastardized version of that, where what's happened is, we're still seeing this push for more and more, privatizations and things like that. But we've had this rise of the political economy where the political company where they're making lots and lots of donations to political parties, and they're using that to protect their rights to try and write regulation and to really just embed themselves at the teat and keep sucking. So and not letting anyone else, the smaller companies in. So I think until we see a real backlash against that, it's a bit like the whole. I've spoken several times on the show about a similar issue happening with the gap between the rich and the poor, and rich people don't spend as much, and poor people, if they get more money, rich people don't spend it, whereas poor people do, and so we have this lack of demand. And I think that's another factor which is driving a lot of this as well. The rich getting richer, the bigger companies getting bigger, and until we get a real solid backlash against that, I think we're in for more of the same.
Yeah, and it's a really interesting question in my mind as to what that backlash might look like, and whether in fact it will be politically driven. I'm not sure it will, because it seems to me that the politicians are quite aligned with the big end of town, or whether it will take something else. Will it be a recession or something which will actually break? And I keep trying to work out what's going to break next, because we seem to be keeping all these balls sort of in the air, but at the cost potentially of individuals having to pay a lot more for everything. But it doesn't actually really drive the economy necessarily to a good outcome, in my view.
No, and the question about what's going to break. Last time we spoke, I think I had a half a dozen things I was talking about that could be the thing that comes next. And what we saw in terms of this banking crisis has changed my view. I should explain, I guess, my thoughts on the banking crisis is that it's not going to spiral out of control. That what we've seen is, yes, there's a number of relatively idiosyncratic issues with individual banks that sort of either caused them, say, Silicon Valley Bank to fall over, or First Republic, or some of these other crypto ones that were heavily involved in crypto. Credit Suisse, which was sort of a little bit of seen as a weak member of the herd, and sort of got carved off, and they had their problems a year ago. But all these ones that had been generally made mistakes with interest rate hedging and the speed of interest rate rises. So they were basically caught out by the speed of interest rate rises, which led to them going under. That's not broad to every company. But what is broad, and especially right throughout the US banking sector, is this pullback on credit. So the regional banks in the US have lost a lot of deposits, and their funding costs have gone up quite significantly, and they've responded by pulling back on credit and not lending as much, and tightening up who they are lending to, and that's causing a credit crunch. And I think that's the next shoe to drop. And that's the one where we're urgently sort of keeping an eye on everything we can see that's coming out, with the view that that seems to be the most likely event now. Is they wind back, you get the US, you start to see some corporate bankruptcies, and then that sort of flows through to the real economy, and that's the transmission mechanism for this next downturn.
And presumably that means that the risk profile becomes an important question, right? Because there will be potentially some lending that won't happen now, and potentially that might be to people who need the credit more or whose risk profile is a little less good, whereas other sectors... Oops.
Sorry.
It's all right. There you go.
Yeah, so you're right. It's about the availability now of this credit, and it's very hard for central banks, while they're still raising rates and everything, to then turn around and say, well, we're raising rates, but we're going to try and turn the credit taps back on, because the reason for them raising rates is because they do want lending to slow. Like that's part of the mechanism. What I wanted to show on this graph, this and the next one, is I've got a couple. The key to this one is I've got this dark blue line, which is a small business survey, and they're talking about what their expected credit conditions are in the next 3 months, and it's been extended a year forward. So it's like, it's been shifted out. And so when things are really high, you've got tight credit conditions, and when things are really low, you've got loose credit conditions. Then the teal line on this is showing bankruptcies. So it's over a sort of 35-year period. We can see we're at sort of 35-year lows in terms of bankruptcy filings, but the bankruptcy filings almost always follow that credit conditions, and that's the credit conditions we've seen tightening quite sharply in the last little while, and we're expecting that credit conditions to those bankruptcies to really start rising. Now this bankruptcy is all types of bankruptcy, so that includes people. What you generally do see is that companies are the ones that start having problems first, and then that flows on to job losses, which then flows on to people sort of having bankruptcy later on in the cycle. And if you look at US bankruptcies through to March 31, so 183 bankruptcies. So what this chart's showing is the top line is the total bankruptcies for the entire year, and the bluey green color is at the bottom is how many bankruptcies have happened through to the 31st of March. And so biggest year for 10 years, 15 years, back to 2010 for bankruptcies so far this year. And that's certainly continued. And this is pretty much pre the credit crunch as well. This is before this stuff really started to hit. So we already had this going on, and now we've got small banks, pulling back on lending. If you look at the UK, they're steaming ahead as well in terms of insolvencies are taking off. You look through the European Union, the total, which is the black line, is only marginally above sort of prior levels, but there's a couple of sectors. This one's broken out, just sort of showing transportation and storage and accommodation and food services, which are a lot. Europe's been hit a lot harder by the whole energy crisis, but there's obviously a few sectors that are really getting smashed over there, that are sort of running at double the bankruptcy rates of what you've seen elsewhere. And then back in Australia, we've got it's similar in terms of we're seeing a lot in construction, but this left-hand side of the chart and the black line is the total number of corporate insolvencies, and so we've come off that COVID lows, and we're sort of back up to more normal levels, but hasn't actually sort of started to reach higher. And that's where I sort of feel a lot of these lines are similar. They're sort of coming from record lows, but they're getting to the stage where you've got to start being concerned in terms of they've shot up so quickly. Will they now flatten out and everything will be fine and just we'll go back to normal, or are they going to keep pushing through? And to me, the odds are that they keep pushing through and going to above average in terms of bankruptcies.
And if you look at sectorial analysis, for example, in Australia, the construction sector is particularly bad hit at the moment, right? We're seeing a number of organisations who are falling over and leaving half-built properties all over the place.
Yeah, that's right. Construction's bad. Arts and hospitality is bad as well. Retail wholesale is pretty good, but it hasn't really, it's been running at sort of its 10-year rate. And what's the other one? And mining and manufacturing, which comes together. So I doubt there's a lot in the mining sector in that. So I think that's probably a lot more manufacturing there. That's really starting to tick up now as well.
Yeah, and I think the lag, interesting, is what we're thinking about, right? Because when you start seeing corporates fail, that's events that's already happened that created the trigger. Because it can be 12 months, 18 months, 2 years.
Absolutely. Takes a long time for these to go. And this is part of I think we spoke on before about this, saying especially in Australia, the tax office basically just stepped aside for the pandemic and just didn't chase debts, and they're back. And so, if they started, and I think it was sort of September-ish last year where they really started pushing. So, if somebody with a big tax debt getting pushed in September, it's then going to be into December, January before they're really starting to engage. You're probably another 6 months of trying to get out of these and redo things before the ATO would finally give up and say, okay, that's we've given you enough time and call the receivers in. So I think it's coming still over the next little while. We're going to start really seeing that ramp up in Australia.
And I was speaking to an insolvency practitioner the other day, actually, in Australia, and they're saying they are now busier than they've been for the last 2.5, 3 years, and they've got a huge pipeline now of things they're having to deal with. Yeah.
Yes, that sounds very likely to me, and so I think there's that sort of ties a little bit into where I wanted to go with the interest rates as well, because I wanted to talk a little bit about this fixed versus the discounted rate versus the normal rate and the fixed rate, and how this flows on to consumer bankruptcies. So I might share again if that's all right.
Yeah, go for it.
So I've got this line here, and I guess what I'm trying to say here is that I feel as if the interest rate for the new home buyer or somebody who's refinancing their loan, I'm arguing hasn't changed for the last 5 or 6 months. And how I'm arguing that is I've got this dark line here, which is what I'm calling the effective interest rate. Is the thickest line on this one. And I've got 2 other lines. One is the 3-year mortgage rate, and the other, that's the dotted line, and the dashed line is the discounted standard variable rate. And what I'm arguing is that, look, when somebody's buying a new property, refinancing or whatever, and they've got, there's some cash flow issues and they want to try and get the lowest rate possible, people sort of have this choice between, well, do I take, if the 3-year rate's lower than the standard rate, I'll probably take the 3-year rate. If the standard rate's lower, I might take the standard rate. Just a pure whichever one's lower. And the issue we've seen over the last 6 months is, well, the 3-year rate rose quite quickly through to the end of the last year, but then it hasn't changed, or it's actually even been coming down a little bit since then. And so, the idea that the minimum rate really has been the 3-year fixed rate, and so while the variable rate now is going higher, for somebody who's coming in new, if you came in last month or the month before or the month before that, the 3-year rate was the 3-year rate. It's no cheaper than or more expensive than what it is today, despite the fact the RBA's added another 25 basis points. Now, maybe that will change because expectations will change or whatever it is, But at the moment, that hasn't really happened. And what that's meant is that's affected, and that sort of coincides largely with where house prices stopped falling, and we started to see some house price rises. So that's one part of it, and I'm building towards the next part, which is saying, if you look at the discount that banks will give between their standard variable rate and their discounted standard variable rate, it used to be sort of 0.5%, and then for a long time it was somewhere between 0.5% and 1%, all the way up until 2020, effectively. Now we're almost 1.75% is the discount. There is a big discount between the people and between people who banks want and people who they don't really want. And so what that's giving us this price bit where somebody who is a marginal credit is turning up to a bank, and the bank's saying, well, you're going to pay 8%. And somebody who's fine, no real cash flows, and lots of equity in their property is probably getting 6% on the same loan. And this is the part where it's the rich getting richer and the poor getting poorer. Is the issue is, does that create a housing crisis or not? Now, if you have enough people start to fall over because of that, then yes, we're into a housing crisis. If it's only around the edges and a marginal, then maybe they can keep carrying this through, and house prices might not rise quickly, but they might not fall, I guess, until and then if they don't fall that much, and then you start getting some big interest rate falls, then you might see house prices take off again. So that's your positive view. Your negative one is, no, there are enough insolvencies and enough bankruptcies within people that that really starts to fall away. So, and the one more step to that is that then we have corporates, and if the corporates are going bankrupt first, then you start to see job losses, and that's what also forces people to sell houses. So, there's this culmination of things coming over the next 6 to 12 months. That could be a mix of people, the people who are most vulnerable being hit with higher interest rates, and people starting to lose jobs, and that sort of some forced selling, and that could sort of send the house prices down again. So that's and I think there is a reasonable chance that will happen. I'm sort of not making any major bets either way, but very aware of the risks on both sides.
Well, it is interesting insofar that banks have been deeply discounting to certain types of borrowers to try and get those refinance deals through. But we know that there are other people who are having to pay a lot more just to get a loan. So you're seeing a real bifurcation in the market between the lower risk and the higher risk business. And in my modeling, we're now seeing more people falling over into that high risk bucket, which means that if you are in a low risk environment, you'll do fine, but the high risk category is getting bigger and bigger, and that's a worry, I think.
Yeah, the snowball is starting to roll down the hill, and it's getting bigger. Now, will it keep rolling? Will it hit a rock and stop, or will it keep rolling and turn into an avalanche?
Yeah.
And that's the part where I think you need to be very aware of the risks of the avalanche. And if you're going to make a decision, to say no, the opposite's going to happen, then make sure you're watching the indicators to know what you want to do with it. We've sort of taken the view that look, we're going to protect ourselves from an avalanche in case it comes, and we'll protect ourselves from a sort of moderate sized one. And if it turns into a massive one, we're going to have to duck for even more cover. But we think there's enough danger signs around that it's worth changing your portfolio composition to take that into account.
Yeah, and I think it's quite interesting that the bank economists were almost universally changing their view over the last 2 or 3 weeks as to how this is going to play out. They were talking about interest rates not rising, housing pricing recovery, etc., etc. Now they're probably talking their own book possibly, but I wonder whether they will now change their mind again, given what the RBA did, and given this bifurcation, and of course that cliff. however many million or 100,000 or whatever it is, there's quite a few households whose mortgage cliff is coming. I think July is the peak, according to the RBA.
Yeah, that's right. The next, well, it's happening right now. Yeah, right now there's people turning up and having to refinance it. So, and yeah, as you said, it's the next six to 12 months. You get the bulk of them out of the way. Look, this was, I mean, part of our argument for the last year has been that, and the reason to be sort of underweight equities is that we've got this central banks raising rates to cut off inflation, and what they've been saying is they need to tighten financial conditions. And if they don't, if things keep growing and we keep having the inflation, then they'll keep raising rates. And so this is part of the issue is, the RBA is looking and saying, okay, well, actually the housing market looks like it's bottomed and maybe even turning. Therefore, we can raise rates further without causing any problems. And they want to keep tightening up, and so the idea is for us has been very much that in the good scenarios where you're looking and saying, okay, maybe things turn out a little bit better than what we're expecting. Well, what that means is then the RBA or the US central bank or the European central bank then needs to raise rates further to slow things down. And so it's been a little bit of an each way. Well, things will either go badly and then we'll be right. Or if things don't go badly, then the central banks will keep raising rates until they do go badly. And so, that's...
And in that scenario, the policy misstep problem gets ever bigger, doesn't it?
Yeah, oh, absolutely. And this whole idea of, that monetary policy works with long and variable lags, somewhere between 6 months and 18 months. And our first rate rises were about a year ago, and from the lowest rates we've effectively had for a century, and so we've still got no idea with how much this is going to, and central banks don't either, how much of it's already embedded in the system, and it might be that their settings were perfect 6 months ago, and that would have given them a beautiful soft landing, but they don't know because they don't know how long those lags are happening and how long it takes for everything to come through.
Absolutely. Yeah. Interesting question from Nick. I might just pick this one up, which was, why has housing not crashed in the UK to the same degree as in Australia? Well, the short answer is that in the UK, southeastern English, around London, property prices have moved up, but actually look elsewhere, it's a bit different, firstly. Secondly, the Bank of England had a very different approach in terms of limiting credit availability through LVR and LTI multiples. And thirdly, the banks learned a lot earlier the mistakes they made through the global financial crisis, and therefore tightened their lending standards much more than in Australia. So I think the bottom line is that people are less leveraged in the UK relative to Australia. And I think that explains some of the differences.
Possibly as well. Also, I think wage growth has been a fair bit stronger as well. Is the other those other ones, because that's part of looking through the Aussie numbers, and we've got this. In the statement today, they're already saying, well, wage growth is low still. They're saying, well, I think their exact words were something along the lines of, is consistent with lower inflation. And what they're saying is, real wage growth is terrible. Like it's we've got nominal wage growth, so up, before you've accounted for the effect of inflation, which is running at pretty low rates. Relative to where it should be. It's sort of 3-ish%, and then they're expecting it to get to 3.5, or even, I think 3.5 and then 4. I think is what their expectation was. But that's not good wage growth. That's pretty average wage growth, and meanwhile we've got inflation running way above that. So in terms of real wages after accounting for inflation, it's almost never been lower. Like we've very rarely have had this bad of an outcome, and and that's UK's. If UK's got a bit more nominal growth, I suppose they've got bigger issues with inflation as well. But
The inflation in the UK is horrible at the moment and will continue, I think. But interestingly, Tarek Brooker and I did a show last Friday, and he showed the real wages growth or lack of it by different demographic segments. And in fact, younger household groups have gone backwards more dramatically than older household groups. And that's very interesting, I think, because it shows once again how ununiform this whole thing is. There are segments that are really badly hit.
Yeah, well, I know a number of people who involved in the hospitality sector in particular, and 6 months ago, they're all hospitality people were all crying out, can't find workers, and the suggestion is, oh, do you think maybe you should put your wages up? Is how can we possibly do that? We'll put them up when we're forced to put them up because the minimum wage goes up. We're happy to complain about not having enough people. Now the immigration gates have been opened and students have flooded in. Now that's not a problem anymore. It's there's lots of people around, so it's I can understand that for a while there, the younger people did get a bit of a pickup while there was we need more people back in these jobs, but now that we've opened the floodgates and allowed hundreds of thousands of students and some of them a lot of them I would call students in inverted commas, where they've sort of come to Australia notionally for a student, but more for the residency path. And they're out there trying to work, and all credit to them for getting out there and trying to work. But that is what is keeping our wage growth down, and I've got no doubt that will affect younger people more than it will affect older people, because that's these are generally younger people competing with other younger people for jobs, and so they'll keep those wages down.
Yes, and the migration tap, 400,000 plus, that's just going to reinforce it, isn't it?
Yeah, absolutely. But I guess there's one of the things that has come quite clearly out of this as well is that the government's got no idea what they're doing in terms of how many people are going to come through. We think it's 200,000. Oh, maybe it's 250. Oh my God, it's 400,000 or 500,000. And let's spin that into a good thing now, as opposed to So I do think there's an element here of showing that really they don't have a lot of control over these things, and I think that they seem to be, the narrative seems to be around justifying what's happened as opposed to what should be happening. There doesn't seem to be a lot of strategy behind it.
Are you surprised?
No. But,
well, partly because the political cycle's short, right? Next election. And the other is that some of the issues that we're looking at here are quite deep and intractable. I mean, the housing situation has been going bad for 20, 30 years. The concentration of big businesses and their control on the economy has grown significantly over the last 20 to 30 years. So these are big structural issues. Politicians don't want to go near them.
Exactly, and you see without a hint of irony, you see big property developers out there talking about how we need to bring in more people to build houses because we brought in so many people, and they're just like, so you basically it's a hamster wheel. You're just like, we need to bring people in to build houses for people that we're going to bring in, and then we'll need more people to bring for the next set of houses, and so that property developers obviously love more people the merrier. But then you go through all the different ones, and you go, if you're a Harvey Norman, Woolworths, Coles, whoever you are, and you've got all the best retail sites already, and if you can jam pack more people into the area around you, a few extra thousand people within a few kilometers of your store, fantastic, sell more stuff. And so I think there's obviously a lot of vested interest involved, and wow. and they're the ones to be buying, at the right point of the cycle, because until we see things change, it's an issue about getting the quality companies, and the ones who are, have got that, who we think can hold on to these pricing power, which is not, or is probably not a good thing from a social stance, but in terms of investing, that's the ones we're looking at.
Well, let me just talk a bit more about this issue of where to invest, right? I mean, I'm looking at some of the US tech companies who seem to have remarkably bounced. I mean, Meta's a good example, right? But when you actually look at it, it's a little bit artificial, isn't it?
Yeah, so the reporting season. Okay, there's a couple of things I want to talk about in the reporting season. Let's take Meta to the side because they are very different to the others, and they've had that's one that's seen the most amount of earnings upgrades, sort of 40% ish earnings upgrades or more, and other
Stop
things going on.
spending a lot of money on stuff that may not return. Guess what happens?
Well, yeah, exactly. So let's put Meta aside. We'll come back to that one. In the broad sense of companies, so if you look, more at you know medians and things like that. So you don't like doing it. You don't weight the bigger companies more. So if you just look at the what's happening is it's been a pretty poor reporting season. We're seeing lots of downgrades, and the downgrades are bigger than the upgrades. So if I look at the what I call the 25th percentile versus the 75th percentile, which is just sort of a crude measure of saying, well, what's the worst 25% of companies doing and what's the best 25% of companies doing, is that the best 25% is upgrading by 2%, and the worst 25% is downgrading by 6 to 8%. So the downside skew is more than the upside skew, and companies in aggregate are downgrading their earnings on the back of the reporting season. So that's one part. Then, though, what happens is we've got the largest companies which have been coming in with some reasonable results, and that's meant that when you look at the average, because the larger companies make up such a big part of the market, is that the average has been rising in terms of the average multiple and earnings. Now, if I go through some of the bigger ones, especially the tech ones, the Microsoft result was good. The Google result was probably, you'd probably call it not bad rather than good. Like it was. I think the concern there was that it might be bad, and so that sort of came in all right, and so that was sort of a bit of a tick. The Amazon, I'd say, is actually got some issues and some concerning issues that's around there. So they effectively, Amazon is three things. It's a US distributor of seller of all these goods and online, and that's marginally profitable. It's not too bad. It's not great. Then it's an international business which is losing basically whatever it makes in the US, it loses overseas. And then attached to both of those is this thing called AWS, which is their web services, and that's fantastic. Makes huge margins. We use it for a lot of our stuff. It saves companies sort of maybe 90% over doing it themselves, but at the same time, it probably Amazon gets to make margins of sort of 50 and 60%. Like they're already, they could, it could be 95% lower, but there's, so the companies are very happy because they're like saving 90%, and Amazon is very happy because it's making all this great money. Now the margins there shrunk quite significantly, and so there's some stuff that is still not entirely clear to me exactly what's going on there, but there's certainly enough warning signs to be a little bit nervous about that. And then the big one, Meta, in terms of that, really jumped in terms of its earnings. It's had earnings upgrades of 50, 60%, of 40 to 50% in terms of the earnings upgrades. Now, that's a mixture of three different things going on. One of them is Meta is spending a lot of money on what it calls reality labs, which is basically a 3D, and the metaverse. It's basically a 3D software. And what they're trying to do is create this idea that where things are going to go is in the same way that everyone was on desktops and PCs, and then everyone went mobile and everyone was on smartphones. Is that the next iteration is everyone into the 3D, and they're going to need goggles to do it, and they're going to need the software to run it, and they're going to need the avatars and all this other stuff will need to go in behind it. Now they've been spending truckloads of money on that. And not making any profit. If they shut that down tomorrow, they would add 50% to their earnings. And so the question is, so if they're making $100 on from their ad revenue, and then spending 33 of that to try and set up the metaverse and reporting 66. Well, how do you value the company? Do you value it on $100 and say this other expense, you could say that Reality Labs is worth zero, or do you value it on the $66? And that's we bought quite a lot of Meta, over the last year or two, and we've been winding back as sort of this rise has come through, because we basically went, well, the $100 is what we care about. And now Meta's been pulling back on their spending, and so and they no longer spend $33 of every $100 they make on this metaverse. They're starting to pull it all back and be a bit more commercial about the whole decision. So there's that part. Then the two other factors is they increased the number of ads they show dramatically. They had some subscriber growth, relatively small subscriber growth, but it was positive, whereas it's meant they've had a few negative periods. But they increased their ads by I think it was 27% or something like that, and at the same time their ad rates fell by 18%. So it's this weird. We showed heaps more ads to everyone, but we got a lot less money as well. And so, good result, good upgrades, all that stuff's going on, but there's a lot of quite individual things going on with Meta. And while I'll sort of celebrate and say, yes, we owned lots of it, we're happy, we're taking the profits and selling down as it's rising, I wouldn't look at them and say, oh, this is a microcosm of what's happened. They've got some very individual things going on, and I don't, and that's sort of when you look at some of the aggregate numbers, the growth from Meta has overshadowed what's going on elsewhere.
Yes, and interestingly, you've got to also think about this in the context of AI, right? Because the AI story, which has really taken off over the last 6 months or so, is really quite concerning in my view. I don't know whether you saw what.
Actually, can I cut you for 1 second on the AI? I've got one last chart. I'll just show you one last chart, and then we'll go. Let's do AI. Okay. Because the other one I want to talk about is, are analysts still too optimistic? And my answer is a resounding yes. Yep. So what I'm showing here is US S&P. Each line is the earnings growth that was expected when they, over time. So the blue. Let's take the blue line for example. This is first quarter earnings, first quarter 2023 earnings. So a year ago, analysts thought it was going to be 13% growth, and then as the year went on, they downgraded that to below 10, and then they kept going, and now we're sort of close to a whatever it is, 7-8% loss. And we've still got the rest of the reporting season to go. Second quarter earnings, same thing, downgrades. Third quarter, the downgrades are partway through, but analysts are still expecting third quarter to be positive, and fourth quarter they're expecting a boom. So, which is sort of the and back to sort of 10% growth, which is sort of the opposite of what bond markets are telling us. Bond markets are saying there's a recession coming in the second half of the year, and equity markets are saying no, earnings will be fine. We've got it's going to be bad for the first quarter of the year, which is already finished. It's going to be bad for the second quarter of the year, which we're 1 month into, and only got 2 months to go. But after that, everything will be fine. We'll be back to growing, and that seems extremely optimistic. And history sort of, if we are going into recessions, these numbers have got 10-15% at least to fall from where they are. So analysts are still wildly optimistic, and we're still expecting lots of downgrades to come. Yes. Anyway, AI. Sorry to.
No, that's good. And just before you go on to AI, I just want to underscore what you just said, right? So, if in fact the earnings are over expected, equity prices, particularly in the US and maybe even in Australia, are still way too high. They are still priced for that perfection, which we don't think is going to come.
Yeah, absolutely. So there's this part where earnings. So we're priced at sort of the upper ends of historical ranges. So I should have grabbed one of those charts, but I'll me bring it up in the background. So basically, what if you're looking at pricing, if you get price to earnings ratios, which is sort of a pretty reasonable summary of a lot of other ratios. You do need to look at more than just one, but we'll use that as the primary one. Usually, if they're trading over 20 times, it's only really happened in really extraordinary circumstances. So the tech boom had happened, and in post the pandemic, we saw that earnings trading over that 20 times. We're pretty close to there already. So we're right at the bottom end of that range. It's 19 times in terms of global PEs, excluding financials and resources. So, and US ones I think are over 20 times at the moment in terms of if you exclude financials and resources. If you go to Australia and do the same numbers, we're well over 20 times. So, so if you're talking percentiles, I guess the market at the moment is in the top 20% of the ranges where it's been in terms of being expensive. That's the global market. The Aussie market is in the sort of top 5% of being expensive. Now, the Aussie market has, has other things going on, where, and in particular, we're very heavily skewed to resources and very heavily skewed to banks, which do tend to have lower PEs. So if you look at the average for Australia, you look at the average and go, oh yeah, everything looks fine. But if you just split, all you have to do is split Australia into 3 different sections and say, how do the non-financial, non-resources companies look? And you go, they're really expensive versus overseas peers. Then you say, well, how do the Aussie banks look versus international banks? They look really expensive. They're the most expensive relative to international, relative to other sectors. And then you say, and how does resources look? And you go, well, resources are a bit expensive. It's not way out there, but the 3 sectors of the Australian market compared to the appropriate peers all look very expensive.
So that makes it quite hard then to really go into the market other than in very selective areas where you think there's going to be pricing power into the medium term. Yep. So larger players rather than smaller players, presumably maybe in some of the retail sectors and technology sectors. But it suggests to me that banking, for example, is probably way overpriced. Yeah, well, and it is, and and it's been underperforming. It's still, it's actually become more overpriced, even though it's been going down. It's become more overpriced because the US banks fell by so much. So the US regional banking sector got smashed, and European banks as well got hit, and the Aussie banks got hit, but nowhere near as bad as what we saw in the US or Europe. So so now they're even more expensive relative to global peers. So I guess what I'm saying is, if you're a believer that, hey, banks are going to be fine, Martin, Damien, you're wrong. It's all going to come out smelling great. Is saying, well, if that's your view, I still probably wouldn't buy Aussie banks because there's much cheaper banks elsewhere that you can pick up. And so, yeah. And of course, Aussie banks are overexposed to the property sector, dramatically so, relative to international peers.
Yes, absolutely. Yeah.
European banks have got... Go on. Sorry. Let's talk about AI briefly. The guy who used to run the AI project at Google just resigned, and he came out today and said that we're sleepwalking into something we don't fully understand, and we'll get to the point where AI becomes more intelligent than we are, and that's a problem, because of course it can tap into the entirety of the internet, be that good or be it bad. And in the last 6 months, it's been a huge momentum, a lot of investment, a lot of public commentary about it, a lot of rubbish produced by ChatGPT, for example, as well, because it's only sucking stuff out that's there. If it's wrong, it's still wrong. So what's your take on the whole AI thing, Damien?
Yeah, look, I think there's the things I want to highlight on that. There's lots of potential that you need to be thinking about, and which can win and which can lose out. So first of all, I think the real breakthrough has been the interface. So there's AIs, the things that GPT is doing is similar to what other AIs were doing before, but it's much easier to actually use now, and then so the number of people using it has dramatically increased. Now the thing about it is that actually is very helpful for machine learning in itself, because if I've got 1,000 people testing my chat GPT out, and they're going, no, that was the wrong answer, that didn't answer the question I did, and that did answer the question, and this one did, and it's getting 1 out of 4 wrong, and I've only got 1,000 people, so I'm only collecting so many errors every day. Whereas if I turn that into millions of people, now I'm collecting all these errors, constantly throughout the day, and it just means that it gets better. There's a really good analogy. I must admit, I can't remember the guy who to attribute it to, and I left it off my slide. But he made the analogy of talking about companies manufacturing, and it used to be that when you ran manufacturing, you ran it off steam engines. And so what you did was, when you made a factory, you had this big steam engine sitting in the middle of the factory, and you built everything around it. And it meant multi-story factories, and everything was all about, how do we hook into this and send off conveyor belts and all these other things to make our factory, as efficient as possible to use this steam engine. Then electricity comes along. And the very first thing everyone did was replace this steam engine with electricity and left the factory in place. And it wasn't for some time before people actually went, hey, just a minute, we no longer have that constraint. We don't have to build the factory in all around this central engine. We can now spread out, and we can actually create these long factories that are way more efficient, where stuff comes in at one end and the process goes, and it spits out the other end, and things just move along, and it could be on cheaper land, and all these other things like that. And so and that's where I think a lot of this AI stuff is going as well, is that there is years and decades of improvements of stuff coming, because the tools are going to create more tools. We're going to start using this stuff in ways you've never thought about, and you won't think about it until it's hard to think about these things because we're stuck in this version of the old way. And so I'm likening this to this explosion in AI to the movement to use the internet. I think is similar. I think the introduction of PCs into offices is similar. It's a groundbreaking moment. It's going to create lots of efficiencies for people, but it's also going to create job losses, and it will create lots of productivity gains. So another good example and is that if I look back in the 60s and 70s, almost everyone had secretaries and people to they'd write up inter-office memos, and you need someone to type it up and then distribute it to other people and bring it back, and all this stuff around how do we have people within companies talking to each other. Then we brought along PCs, and people could start doing the typing themselves and didn't need to and could start communicating. You got inter-office emails, and that sort of meant that rather than pretty much 1-to-1 for assistance, all of a sudden you were 5-to-1, and then you brought out the internet and scheduling machines and calendars and all that type of stuff like that. And now you're 10-to-1 or 20-to-1 in terms of assistance. I think there's a similar type of thing going on with this, where say you're an architect or a programmer, and let's take a senior programmer. You're a senior programmer. You have a bunch of other guys out there, and you put together your design of how this thing's going to work, and then you say, okay, employee number 1, you go away and build this little thing for me, and employee number 2, go away and build that bit, and number 3, go build that bit, and then I'm going to bring them all together. Now with a lot of these tools, these AI tools, you just don't need those 3 people anymore. You can just say ChatGPT or whatever AI tool you're using. You go build that thing for me, and it's not going to be perfect, but you know what? The thing I was getting back from that employee wasn't perfect either, and so and so the amount of productivity from one person will rise. Does that mean there's going to be some of those people are going to be laid off? Sure, it does. also means you might expand and do more. I suspect what will happen though is it will require more jobs to be created in other industries. I do think there's a reasonable amount of. I think this is getting more attention play than others because there are a lot of journalists whose jobs are at risk, and it's one thing for a journalist to write about, hey, there's these factory workers that are going to get automated out of a job. That's sort of a certain interest to that journalist. When it's talking about journalists getting automated out of a job, I think they're a lot more interested in that, and so we're going to get a lot of this reported on, and so it is a lot of white collar jobs that are being affected. And it was an interesting one as well that was that given that some of the AI for say driverless technology is taking longer than expected, it's actually interesting that this AI seems to be hitting the white collar side a lot harder than say some of the blue collar. Now that could easily change if there's enough breakthroughs in driving technology, but there's I think this is going to create a lot of change, and it is going to create get rid of a lot of jobs, which is fine if you've got jobs to replace them, and can be very bad if it's sort of treated as from a government perspective, it's treated as, oh, well, that's bad luck, that's just progress, move on. I think if the government treats it as, yeah, look, it's progress, we're going to help you and we're going to get you into new sectors and we're going to get new jobs up and running, then it can be, you can get through this with a huge burst of productivity. I think if you don't do that, then you can get through this with a huge burst of political instability, while all the people who lose jobs, create issues for it.
Yeah, and as to where it may lead, well, nobody quite knows, right? Because the rate of innovation is continuing to accelerate. And think back to Moore's law and the computing power. And if you think at the latest, micro versions of computing power, which they're now experimenting with, and think about the additional processing power that can lead to too, who knows where this all leads to? But it's an
exponential, yeah.
Yeah.
Now, so who benefits from this? So this is again where it comes back to quality companies. So this is the and I don't want to harp on saying quality companies are always must be the answer, but at the moment I'm saying, okay, into a recession, yes, you want quality companies. When you're coming out of the recession, that's when you want to go more to growth companies. In the end of the cycles where you're in value companies. So that's one part. So I'm not just talking up quality company always, but in this case I am, because we generate this all of a sudden. Let's say you're a lawyer and you no longer need 3 assistants to say go draft something up, go draft the letter up for that, and go draft the letter up for me for that, and then you'll do 90% of it. I'll come back and fix it, and then we'll send it off to the client. Now he can send that to ChatGPT. Go draft this up. Go check out stuff for me and bring it back. Okay, so ChatGPT is not perfect yet, but there's tools coming and they're getting way better, and that's going to be that will be a real thing. Now, who benefits from that? There's either the company that employs that lawyer, fires 3 assistants and all of a sudden makes all this extra money is one possibility. Another possibility is that one lawyer who's left. They still fire the 3 assistants. That one lawyer who's left goes, hey, I'm way more important now. I want a much higher salary, and it goes into higher wages for more technically competent people. And the third one is they go back to their clients and say, hey, we don't longer need to charge you $500 or $600 an hour. We've just fired a whole bunch of people. Now we can charge you much less for your legal advice. So each industry will be different. The quality companies are the ones and that can go to their employees. Okay, yeah, we'll give you a 5% pay rise or 10% pay rise, but we're customers are still going to pay the same, and we're pocketing most of the difference. There'll be other companies out there that will it'll all get competed away. So they will look at it and they'll say, oh great, I'm going to fire my 3 assistants, I'm going to make all this extra money, and then all their competitors will fire assistants as well and start cutting their prices, and they'll be forced to cut their prices as well. And then so Yeah, so you want the quality companies that can hold on to those price rises. Now, what are the sectors that I think you need to be keeping an eye on? And I've got a long list of them, but media is probably the big one. Um, Copywriting, if you are a copywriter or you've got friends who are copywriters, I would be investing in some education and working on what else can you do, because uh, if if you're working as someone where somebody goes, here's 10 bullet points, turn it into a story for me. That's the type of thing that chat GPT and these other language models can do very quickly. So copywriting, marketing, I think has got that same thing where a lot of the assistants will be laid off. Video and music as well. Some of the things you can do now with some of these models in terms of creating 3D images of people and different ways of creating music. So I still think there'll be artists and people will still make money from creating new things, but the number of assistants that they will need to produce these will be far less. And you look at your movie end of credits on a movie, and maybe you can halve the number of people you need in terms of those that will be needed for these types of things. In IT, coding, support services, in legal, I think will be affected as well. Transport, you're looking at logistics, driving, flying, all those types of things. There's lots of there's lots of changes coming through on that front. So, oh, sorry, actually, I should explain those ones. So, logistics is already happening, where there's a big spend there, and lots of work on AI about, there's a thing called the traveling salesman problem, where what's the most efficient way of salesmen going to different cities, and the problem actually becomes so large that it's actually very difficult to solve for multiple cities. But these AI ones can solve that, a lot more quickly, just by brute force, running billions and trillions of simulations. And so, yeah, logistics is one we'll see. Driving is probably the key one, where in terms of jobs, in that whatever you think about driverless technology, giving AI tools to millions of more people is going to open this up to is going to speed it up. So whatever time frame it was on, 2 years ago, it's been accelerated because so many more people have now got tools they can use to do AI stuff, and that in my view is going to accelerate it. So if the driving comes in the next 5 years, this self-driving where you can use that, there's millions of people who will be laid off, but there's massive productivity gains for society as well. So a huge event. Is it 5 years away? Is it 50 years away? Different people have different ideas. Look, it's hard to say. I think you need to have your eye very closely on as well. And then the second thought is, well, actually, once they've sort of self-driving, actually self-flying is actually not that far behind. It's not the problem leap in terms of calculation, computational power. I think for humans to do to have flying cars is actually, well, it's dangerous, and the human mind has a lot of accidents in 2D. Why do we want to go 3D? Whereas if you can get computers doing this, the computational step from 2D to 3D is not that great. Education, you can forget about take-home exams and stuff like that anymore. There's going to be big changes in education. In finance, I think there's lots as well in terms of people being more efficient in various jobs about things like funds management or corporate finance and things like that. Fraud protection and fraud creation as well is up there. Customer service, I think, is a big one right around the world. There's a lot of these AI will be pulling out customer service jobs. I mean, we've already seen things like, you've already got customer service at places like shopping centers where you go and do your own checkout and things like that. This AI will just increase the number of those types of factors that you can get in terms of recognizing images and recognizing, I've just put stuff in my trolley and you don't need people there to check me. And then healthcare, lots in healthcare as well. Diagnosis, wearable technology, R&D. There's some real breakthroughs and real, it's the it's the simplification of using AI that's helping in the healthcare part, where it's basically saying, okay, well, a lot of the technology and algorithms and things are pretty similar to what was being used 6 or 12 months ago. It's just that if you can get less technical people to be able to use it, then all of a sudden, their productivity rises greatly. And similar with the internet and computers and things like that, you had a very capable person, but they weren't a good programmer. Okay, now you brought out drag and drop and click and things like that. Oh, okay, now I can actually do all those things myself, and I don't need to know about the programming to be able to do it. And that's I guess where I'm looking at this AI to do. Oh, sorry. And one other thing I forgot to say when I was talking about the three, I spoke about three main beneficiaries. There's actually four. Sorry, the three was does it all go to the worker and they get a higher job, a higher salary? Does it go to the company in terms of making bigger margins, or does it go into prices in terms of cutting prices? Sorry, the last place it could go to is the people who actually create the AI software. My argument is I don't think they will get. I think they'll get great gains, but I don't think they're going to take the lion's share of the gains. And the reason why is if I had the greatest AI software today in the world and I was 50% better than everyone else, and I said, you know what, I'm going to charge $100 a month for it. And I reckon I can get, 10 million people. And here I go. I'm rolling in it now. I'm making $100 a month from 10 million people, $1 billion a month. Fantastic. The problem is I've got 100 million people. Chat GPT and Google and these other ones are going to be giving it away for free to, 1 billion people or more, 2 billion people. And so they're going to be getting, I've got my limited user base over here, which is gradually getting better. And as I've got this limited user base, they're going to be getting way better because they've got way more people using it. And so I do think the free version, it's a bit like your browsers and things like that. Your internet browsers is like, well, I can have a great internet browser and charge everyone $1 a month and I'll make all this money. But, if Google's giving it away for free and they keep getting better because they've got so many more people using it and iterating it, then, I'm going to lose out. And I think that's where we'll see with the AI as well, is that the AI companies will make good money, but they won't take the lion's share of the productivity gains.
Yeah, it's going to be the harnessing of it, isn't it? And then what contexts creates the value, and then who are the winners and who are the losers. And again, it seems to me that there will be a lot of losers in this as well. Jobs in some areas pretty much disappearing. The unit cost of many other things will be very different potentially, and that can create, margin gain and therefore economic benefit for other players. I also have a feeling that given where the information bases are, a lot of it's actually in English language or equivalent or Chinese. I wonder whether other countries that actually have a smaller language base will be at a disadvantage unless the international translation algorithms can deal with that.
Yeah, that's a good point. I hadn't really thought through that. I mean, I thought through the Chinese side because China has exactly that issue. Yep. And they are quite concerned about that they're not iterating as fast as the US, and so while they've got some reasonable capability, they may well be falling behind at a faster and faster rate at the moment. I mean that actually flows on as well. We're going to talk a little bit about India, and so depending upon who you ask, they're now the biggest country in the world. And that's now the next. We had while you were moving, Mr. Albanese went over to visit and talk about the potential. And some people say this is something that could India could replace China as Australia's biggest trade partner, and all that iron ore and things like that we're exporting could now go to India. And I guess I've got lots of different views on that. One of them will with the AI side, but the first one is, well, they're already the biggest, and how many more people do they need before they're going to become a big trade partner for us? They've had lots of people for a long time, and they haven't turned into a major traded partner. And a lot of that is because they're very focused on services rather than manufacturing. and the services they do tend to be quite low end services. So even the programming side tends to be less about creating the project. And I spoke about before about the AI programmer, the programmer in an AI sense who designs the overall thing and then sends out people to go and do the individual parts. A lot of the time, those individual parts will be done in places like India. They're the ones that are getting replaced. The error trapping side, or to say, okay, I've written a program, it does everything I want it to do, but actually I'm not quite sure about the security and the error stuff. I'll send it to my team in India and they'll sit there and work out whatever security flaws or whatever error trapping needs to be done and other stuff. That's now the stuff that will be done automatically for me. I won't need to send it to India. So they've got some issues there. The bigger one as well with India is there's this thing called a Gershon-Kron growth model, and the
Whoops. That scared the internet.
idea is that. Oh, did they? Right. Using the.
Yeah, you mentioned the growth model and the internet stalled, but you're back now.
I'm back. Actually, let me make sure I'll just up my. Make sure I've got priority so I don't have teenagers stealing my bandwidth here. There's. Yes. Sorry. So the idea is you steal technology. You protect your local companies to a certain extent. You can't have full protection because you need to. They can't fall into the trap of becoming, just reliant on sitting behind trade protection barriers. And then you divert your finance. So you basically you divert so that you've got your so that people within your group. Sorry, I'm just trying to get my speed up. Make sure I've got set my priority as well. Sorry. You divert your savings into these companies to get things going. And if you do it right, what happens is you divert your savings, and so your people become 10-20% poorer because they need to save all this money, and then you take all that saving and you go and invest it. But then they start growing really quickly, and so they get they were earning $100. It goes back to $90 because you've taken $10 to go and invest it, but you've put it into factories and infrastructure and all that, and before you know it, they're actually earning $120, and you're still taking $10 off them, but now they're making more than what they used to, and that keeps on growing. So some examples of countries that have done that really successfully the US did it in the 1800s. They stole technology quite from Europe and protected their companies, and there's Alexander Hamilton has a show out, and a lot of that was his idea was that the conventional wisdom at the time was, England's so good at producing things and manufacturing, we should just stick to growing cotton and digging up resources and sending it back to them. And his take was, no, we're not going to do that. We want to create a manufacturing economy, and they were very successful. Germany under Hitler had a very similar growth model. The Soviet Union early on in the Cold War, before it turned into producing, later in the Cold War where it turned into this real arms race, but early in the Cold War, that was where their economic might came from and how they became a superpower. Brazil had a Brazilian miracle during the 1970s where they grew using exactly this type of growth method. South Korea, Japan, China, all of them went down this growth method. All of those created exactly what, and China in particular, they created this very similar model. You get the manufacturing going, you use up all these resources, you get your infrastructure, you pull in all this iron ore and coal from places like Australia, and you grow your economy. India is absolutely not doing this. This is not their growth model. So maybe they'll change it one day, but at the moment, they're very much a services type model. There's different geopolitics going on there as well. India is a rival with China, but it's very close to Russia. The net effect is it's not doing the same growth model as China, expecting it to replace China, and Australia just rolling on and keep on doing what we did for the 2010s while we had Chinese demand growing is not an option. So yeah, and they're very much at risk. From India's very much at risk from AI. If the AI stuff keeps going the way it's going, then more and more call centers will get flipped over and they'll lose out. More and more programmers more and more low-end programmers will lose their job.
Absolutely. Well, I've always believed that the economic revolution that China created is not going to be replicated in India for the reason you just said, right? And they're also at a different point in the economic cycle. They've got a different footprint in terms of capability. And I think they're actually quite exposed to the AI revolution because, of course, a lot of the stuff that a lot of their people are doing are precisely things that AI could replace.
Yeah, absolutely. So look, India could get it all together, but people have been saying that for as long as I've been an analyst. So I think I started in the early 90s. And so 30 odd years ago, people were saying about the rise of India. It's almost there. It's all about to come, and it's going to boom. We're still waiting for, and I mean, it's great potential. But until you actually start seeing concrete signs of it, I certainly wouldn't be investing for, the Indian century until we genuinely see that making changes.
Absolutely. Well, we're pretty much at the end of the show. We should, I think, just make 2 points, Damien. World Funds and Nucleus Wealth still doing what they're doing. And in fact, I've had quite a few comments from people in recent times beginning to basically ask the question, when is the investment cycle going to turn? How's it going to turn? You've illustrated today that things are still relatively complex, but there are still opportunities if you know where to go look, right? And
absolutely. And some of this is about building up, buying stocks, opportunistically.
Yeah.
As they fall in. Yeah.
But also being aware of what the risks are if, in fact, things go pear-shaped, because I think that the risks are still quite high.
Absolutely. We're definitely on that path. And the other thing to note is we have put out, so we have sort of soft launched a lot more direct indexing options. And so what I mean by that is, so if you bought an exchange traded fund, effectively what you do is you're buying, say you bought an ASX 100 exchange traded fund. They just go out and buy the ASX 100 stocks in equal weights, not equal weights, in the market cap weights of them, and that's what you get within your portfolio. What we've been doing for some time is the ability to take that same portfolio and just cut stocks out that you don't like. What we've also got now is we've got some versions that add stocks in. So for people who who just want, for example, you could say, okay, I worried about climate change, but I love nuclear power. Okay, so I'm going to go. I'd like a global portfolio, the top 75 stocks around the world. I want cut out anything to do with carbon, and give me some extra nuclear power companies, whether it's involved in that, or cloud computing. We spoke about AI. I want some AI and robotics companies. Throw that into the mix as well. And so yes, we can sort of tilt these portfolios in directions that people like. If you come to our actively managed ones, we do that for you. We go out and try and find the stocks and pick what we like. But you can still add in extra as well. So the idea is that what we're trying to do for people is give you the ability to change things at the margins. So you go, well, we're designing the car for you, but if you want leather seats or mirrors, electric mirrors or parking sensors or whatever, we can add them on, rather than saying you got to build the whole thing from the ground up.
Absolutely, and I think that flexibility and being agile, and also the transparency, I continue to say, I think it's a very important set of factors in the current uncertain environment that we're in.
And I'm going to get in big trouble from the people from my marketing team as well if I didn't mention that it also comes with some reasonable size cuts in fees as well. Okay. So we've got a different provider that provides a lot of this functionality for us, and that means we've managed to bring down the fees on all of these as well.
Terrific. Well, thanks for your time, Damien. Really enjoyed the conversation. Good to see the technology is holding up okay across the world. And we'll do it again in about a month's time. Look forward to that. And
excellent. Will this be with your new setup, or you're not expecting a month?
End of May is when it's due to arrive. So we'll see whether I'm on this setup, which is my interim temp setup, or whether I've got the full one on. But at least it sort of works. So, that's the main thing.
Yeah.
Bit of a test of the technology. That's just a little bit of messing around behind the scenes to make it all hang together. But so thanks very much for that. Really appreciate it. And
thanks, Martin.
I'm just going to close the show now, and we'll catch up in a month's time. Take care. Thanks, Damien. And for those of you watching, great to see you all on. Thank you very much for coming and spending some time with us today. I hope you found that useful. Next week, same time, 8 p.m. Sydney, Tony Lacantro will be on. And the week after that, there will be another guest. I think Leif Van Onselen will be on. We're talking some of the economic stuff. So that's the plan, plus some more in the weeks ahead. So we plan to do this weekly from now on. So look forward to that and follow our recorded shows meantime. So this is Martin North from Digital Finance Analytics signing off, and with 2 observations. No doggy cam this week. Meteor's down here. But hopefully in a week or 2 there'll be doggy cams. And in a month or so I should have the full system up and running. See you later. Bye-bye.